Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. Today, we're breaking down one of the most fascinating and, frankly, controversial stories in the market right now. The semiconductor giant, Intel Corporation, ticker INTC. On the surface, it's a legacy titan trying to find its footing. But the real question for us as long-term investors is this. Is the company's multi-billion-dollar turnaround plan a visionary masterstroke that will secure its future for decades? Or is it one of the biggest value destruction traps we've ever seen? That's what we're here to find out.
That is a massive question. And before we get into the details, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comments section.
Perfect. Now let's get into it. Pillar number one, the business model and its historical fortress.
Okay, let's start there. Let's anchor ourselves in what this company actually does, because even with all the strategic shifts, the core product is still absolutely foundational to the global economy.
Right. For decades, it's been, pretty straightforward. They design, they manufacture, and they sell microprocessors.
The brains of the operation.
Exactly. The brains inside everything from your laptop to the most powerful data centers on the planet.
And historically, that was broken down into a couple of key segments, right?
Yeah. Primarily two big ones. You have the Client Computing Group, or CCG.
Yeah.
That's the processors for all the PCs and laptops out there.
The chips most of us are familiar with.
Mm-hmm. And then the real cash cow, the Data Center and AI Group, or DCAI. That's the high-margin server processors that power the cloud.
And for years, those two groups basically made Intel the gatekeeper for computing.
They really did. But now we have this massive, and I mean massive, structural shift that we have to analyze.
You're talking about the Foundry business.
I'm talking about Intel Foundry Services, or IFS. This is the new third pillar, and it's a whole different ballgame.
So explain what that means. They're not just making chips for themselves anymore.
Not at all. They're opening up their factories, their fabs, to manufacture chips for external customers. They're trying to compete head-to-head with the undisputed champions of manufacturing, like TSMC.
That is a fundamental change to a business model that's been in place for, what, 50 years?
It completely alters the DNA of the company. It introduces this huge service-based revenue stream that they've never had before.
Okay, so before we get lost in the weeds of that transformation, let's take a step back. Amidst all this change, and frankly all this chaos, why is the underlying need for what Intel produces still guaranteed for the next, say, 10 or 20 years?
Because the demand for high-performance computing, for silicon, is an ironclad law of modern progress. It's not going away.
It's a structural tailwind.
It's the biggest structural tailwind you could ask for. Just think about the macro trends, the absolute explosion of data being generated every second.
Unbelievable amounts.
Then you layer on generative AI, which has an insatiable appetite for compute power, exponentially more than we ever needed before.
And then there's everything else, from the cloud down to all the smart devices on the edge.
Pervasive computing, it's everywhere. This foundational, non-negotiable demand for faster, more efficient processors is the bedrock. It's the only thing that makes a turnaround attempt of this scale even plausible.
So the world is going to need more chips. That part isn't really up for debate.
Not at all. The debate is about who's going to make them and at what price.
Okay, so let's talk about the fortress Intel built around that demand. The economic moat that allowed them to command such incredible pricing power for so many years. What was it actually built from?
Well, it was really a perfect combination of two things: intangible assets and a powerful cost advantage.
Let's break those down. What were the intangibles?
First and foremost, the proprietary x86 architecture. For decades, all the software in the world, especially in the enterprise, was optimized for Intel's architecture.
So if you wanted to switch, you had to rewrite your software.
Which was a non-starter for most companies. Then you add their vast portfolio of intellectual property, their IP, and these incredibly deep institutional relationships with all the big players, Dell, HP, you name it.
They were just the default, the safe choice.
Completely. And the second part of that moat was the cost advantage, which came directly from their IDM model.
Integrated device manufacturing.
Right. They controlled everything: the chip design, the process technology, and the physical fabrication in their own fabs.
And why was that such an advantage?
because it allowed them to co-optimize performance and efficiency in ways a competitor couldn't. The design team could work hand in glove with the manufacturing team.
Which gave them a technological leadership that, for a long time, seemed unassailable.
For almost 2 decades, yes.
And you could really see that moat in action in the server market, in the DCAI group. You mentioned near monopoly status there. How did that power actually show up on the income statement?
It showed up as pure, unadulterated pricing power, especially with their Xeon server processors.
Those were the crown jewels.
Absolutely. We're talking about sustained gross margins well into the 55, sometimes even 65% range for years on end.
How is that even possible? Why didn't customers just go somewhere else?
Because the switching costs were astronomical. It wasn't just about swapping out a CPU.
It's the whole ecosystem around it.
The whole ecosystem. Legacy software dependencies, specific BIOS settings in the servers, even the thermal management systems in entire data centers were designed and optimized for Intel chips.
So you'd have to retrain your IT staff, revalidate all your software.
You'd have to fundamentally re-architect your infrastructure. The cost and the risk were just too high, so they were locked in. That was the power of the moat.
Okay, here's where it gets really interesting for me. Because despite all of that historical strength, the consensus view now is that the moat's trajectory is, well, it's actively narrowing. The fortress is crumbling.
It is. The walls have been breached.
What happened? What were the seismic shocks that caused this?
There were two, really. The first was the shocking return of a direct competitor, AMD.
They were always there, but they weren't always a serious threat.
For a long time, they weren't. But then they began to aggressively and successfully close the technological performance gap. First in the PC space, which was a warning shot.
Right.
But then critically, they did it in the high-margin server space with their EPYC processors.
And those were legitimate competitors.
They were more than legitimate. They offered a high-performance, high-core count alternative that, in many cases, beat Intel on a performance per dollar basis.
Yeah.
That shattered the guaranteed price premium Intel had enjoyed for so long.
So that was shock number one, direct competition. What was the second?
And the second was, in my opinion, far more structural and more dangerous in the long run. And that was the rise of proprietary architectures.
You mean companies designing their own chips?
Exactly. The hyperscalers, think Amazon Web Services, Google Cloud, Microsoft Azure, they operate at such an immense scale
Right.
that they realized they could save billions of dollars by designing their own custom silicon, perfectly optimized for their own internal workloads.
And they started using ARM-based designs for this, not by 86.
That's the key. Look at Amazon's Graviton chips. They are custom built to run workloads in AWS data centers, directly targeting the same tasks that Intel's highest margin Xeon processors use to monopolize.
So a huge chunk of their most profitable market is now actively designing them out of the equation.
That's the profound impact. It's not just about losing a deal to AMD, it's about a whole segment of the market deciding they don't need a general-purpose chip from Intel at all.
When you look at this whole situation, it just screams of a classic business case study. It feels like we're watching something like Clayton Christensen's Innovator's Dilemma play out in real time.
It's a textbook example. It's almost tailor-made for it. Intel's historical dominance was rooted in the very IDM model that is now resisting this necessary disruptive change.
How so?
The model was built for decades on sustaining innovation within the BiD-AD6 framework, making the chips a little faster, a little smaller, a little more efficient every year. The famous tick-tock.
Right.
That entire vertically integrated structure became too rigid. It inherently struggled to pivot when the market suddenly demanded something completely different, like embracing an alternative architecture like ARM or shifting to a fabless model.
So the very thing that gave them their cost advantage, that vertical integration, became a giant millstone around their neck, preventing them from being agile.
Precisely. And that's why this turnaround, this IDM 2.0 strategy, is so radical. It's nothing less than a desperate high-stakes attempt to escape that dilemma.
By blowing up the old model.
By strategically cannibalizing it. It requires this massive, incredibly painful capital outlay to try and reestablish manufacturing leadership and compete in the foundry business. They're betting they can build a new, flexible, two-sided business.
Selling their own chips and making chips for others.
Before the competition renders their old, rigid model totally obsolete. It's an incredibly costly race against time.
Let's shift to some of the more qualitative aspects, the Scuttlebutt. Looking at customer perception, especially in that server market, we'd often hear complaints that customers felt tolerated rather than truly served. What's the feeling now?
The sentiment is actually cautiously optimistic, which, considering where they were a few years ago, is a significant improvement.
What's driving that change?
Well, that historical tolerated feeling came from the lack of competition. It led to high prices and, at times, fairly slow architectural improvements. Competitors like AMD really capitalized on that, especially on performance per watt.
But something's changed.
What's changed is that Intel's new product roadmap is aggressive, and, more importantly, it's starting to deliver. The new CPUs they're releasing are genuinely getting cautious praise from reviewers and big customers.
So they're back in the game from a product perspective.
They're back in the game. People are seeing the commitment to regaining that product performance leadership. They're still waiting to see if the Foundry promise materializes, but the reception to the actual chips suggests that Intel is, once again, a legitimate high-performance choice, not just the default you're stuck with.
And what about internally, the culture? We often heard critiques of a slow, bureaucratic company that stifled innovation. Has the new CEO, Pat Gelsinger, been able to shift that?
It's a full-on cultural war being waged from the very top.
Yeah.
And you have to understand, Pat Gelsinger is an engineer to his core. He came up through Intel in its glory days.
So this is personal for him.
It's deeply personal.
Yeah.
His whole IDM 2.0 strategy is steeped in this philosophy of getting back to engineering excellence. He's been actively dismantling bureaucratic layers and, crucially, setting these incredibly aggressive public targets for their manufacturing process nodes.
The famous 5 nodes in 4 years.
A goal many thought was impossible. There's a telling anecdote here. Gelsinger has brought back this relentless sense of urgency, often referencing that historical tick-tock model of execution.
A design year, then a process year, back and forth.
Exactly. Now, this pace creates immense pressure internally, there's no doubt about that. But it has also generated a renewed sense of mission among the engineering ranks.
They feel empowered again.
They feel like they're finally being allowed to prioritize technical achievement above all else. And that cultural shift is absolutely necessary if they have any hope of pulling off this capital-intensive gamble.
Okay, let's pivot to that architect himself. Let's talk about management, stewardship, and the philosophy of Pat Gelsinger. You describe his approach as aggressive, long-term, and owner-oriented. What does that actually look like in practice, in the short term?
In the short term, it looks like pain. A lot of pain for shareholders.
How so?
He is laser-focused on securing decades of future relevance for Intel. He's willing to accept and even cause near-term pain things like depressed margins, shareholder dilution, massive cash burn if he believes it's necessary.
He's playing the long game.
Completely. His public statements make this crystal clear. He said things like, "We are putting the foundation in place for the next 50 years of the company." That isn't short-term thinking. That is the classic owner's mindset, prioritizing the long-term structural health of the business over what the stock price does next quarter.
And that brings us to what was probably the most brutal, but as you argue, the most rational financial decision they made, cutting the dividend. That hurt a lot of income investors. Why was it so critical for the turnaround?
It was absolutely critical because in the semiconductor arms race, cash is rocket fuel, and Intel was running low. They needed every single drop they could get.
How much did it actually save them?
The cut saved them somewhere in the neighborhood of $6 to $7 billion annually.
Which is a lot of money.
It's a huge amount of money. But now, compare that to their annual capital expenditure needs, their CapEx, which is often north of $20 billion.
So it doesn't even cover the whole bill.
Not even close. But that dividend money is vital capital that is now preserved for building these new multi-billion-dollar fabs and accelerating their R&D. Without it, the plan is simply not fundable.
So let's apply the rationality test here. They're taking on more debt, they've cut the dividend, and they're committing to this eye-watering level of CapEx. Is this really the only way for them to try and regain that process leadership?
Under the circumstances they found themselves in, yes, it is the only rational course of action.
Why not a more gradual approach?
Because a gradual approach would have guaranteed a slow, managed decline into irrelevance. You simply cannot compete with the R&D budgets and the capital spending of giants like TSMC and Samsung by making incremental, timid investments.
You have to go all in.
You have to go all in. This strategy signals immense commitment and conviction. But, and this is the crucial part, it also signals that the margin for execution error is now razor thin. It's virtually non-existent.
Okay, let's talk about those competitors, the titans they're fighting against. First, you have AMD. with their fabless model. They focus on brilliant design and then outsource the really hard, really expensive manufacturing part to TSMC.
Right, an asset-light model. And then you have NVIDIA, which is just dominating the highest growth area of all AI through their specialized GPUs.
And not just the hardware, but their software ecosystem, CUDA, is a massive moat in itself.
A huge moat. And both of those rivals, AMD and NVIDIA, have these asset-light models that, on paper, right now look financially superior. They have high returns on capital without this crushing burden of $20 billion a year CapEx.
So if asset light is the financially superior model, why on earth is Intel betting the entire company on IDM 2.0, which is essentially a return to an even more intense form of vertical integration? What's the durable advantage they're chasing?
They are betting everything on one concept: co-optimization.
Co-optimization.
The potential durable advantage of IDM 2.0 is the ability to achieve superior cost and performance by integrating the chip design team directly with the manufacturing process team in the foundry.
So the designers and the factory guys are in the same meetings.
In the same virtual building. Yeah. When you own both, you can tweak the chip design on the fly to perfectly match the unique and sometimes quirky characteristics of your own manufacturing process. Things like the specific geometry of a transistor or how power is delivered to it.
Hold on a second, I have to challenge that. Isn't co-optimization just a fancy piece of corporate jargon to justify massive spending? I mean, TSMC has something like 90% market share in advanced manufacturing. They clearly deliver world-beating performance without owning the design.
That's a fair and a fundamentally necessary challenge to the thesis.
So where's the evidence that Intel's way is actually superior, especially when they've been playing catch-up for years?
The evidence, or at least the theoretical evidence, lies in the specific technical details of what they're trying to do, especially with their upcoming 18A process node.
Okay, get a little technical for us.
They're introducing two groundbreaking technologies. One is called PowerVIA, where they deliver power to the transistor from the backside of the silicon wafer, not the front. It's like hiding the wiring behind the wall.
Which frees up space on the front for more important stuff.
Exactly. And the other is RibbonFET, which is a new type of gate all-around transistor. Now, both of these innovations require an extremely tight, intimate integration between the design of the chip and the physics of the manufacturing line.
Something a fabless customer at TSMC can't do.
A fabulous customer can't just call up TSMC and say, hey, can you custom tune your entire multi-billion-dollar manufacturing process just for my chip? But Intel can do that for its own products.
Yeah.
If, and it's a huge if they execute successfully, this leverage allows them to pull performance out of the silicon that a separated design and fab company simply cannot access.
So it's the ultimate high-risk, high-reward strategy.
Highest.
And I guess underpinning this whole bet is the fact that they still have this massive, ubiquitous footprint in the market.
Precisely. You can't forget that. Intel's foundational role in billions of PCs and servers ensures that they remain the default general-purpose compute engine for the world.
Which provides a stable revenue base to fund this whole thing.
A massive, stable revenue base. They're selling their current competitive enough products today to fund the moonshot R&D for tomorrow. That stable funding stream is the only thing making this CapEx commitment remotely viable.
All right, let's look at the financial fortress itself, and it looks like it's under siege. This is where the picture gets really messy. We've seen steep volatility, a significant decline in gross and operating margins. Why is a company that was historically a high-margin monster operating with such, uncharacteristically poor profitability?
It's the definition of a perfect storm.
Yeah.
It's a triple threat that all hit them at the exact same time.
Okay, what's threat number one?
First, they got hit with a severe cyclical downturn in the PC market, the post-COVID hangover. That just crushed demand and pricing power in their big CCG segment.
Threat number two.
Aggressive competition, which we've talked about. AMD and others force them to get more competitive on price, which directly squeezes your gross margins.
And the third threat.
The third is the self-inflicted wound, and it's the most financially punishing factor of all. The massive ramp-up costs for their new fabrication technologies.
Explain what that means.
Building a new state-of-the-art fab is like starting a ridiculously complex factory from scratch. You spend billions on the building and the equipment, and for the first 12, maybe 24 months, your production yields, the percentage of chips that actually work, are abysmal. So you are absorbing these huge costs from depreciation, equipment, and labor, but you're generating little to no sellable product.
So all cost and no revenue.
And that absorption of unyielded costs is what is absolutely crushing their short-term margins right now.
So, in effect, they are voluntarily depressing their current profitability. They're choosing to pay the price of future leadership today.
That is the management thesis, 100%. They are sacrificing short-term margins with the explicit belief that once these new fabs are fully ramped and yielding well, the resulting technological leadership will allow for premium pricing and lead to supernormal returns down the road. The pain is all front-loaded.
Which means if you just look at the standard quality ratios like return on invested capital, ROIC,
Yeah,
they look atrocious.
they look terrible.
If you just opened the financial statement today without any context, you might think Intel was selling, I don't know, used lawnmowers, not designing the future of computing.
That's a very fair characterization of the raw numbers. ROIC has been low, it's been volatile, and it's even been negative in some recent quarters. If you judge the business purely by that single metric today, the only conclusion you can draw is, this is a poor business.
But you're saying context is everything.
Context is the only thing that matters here. The low ROIC is simply the mathematical result of the massive multi-billion-dollar investments in fabs that are not yet generating any revenue.
They've invested the ISC, but they don't yet have the RO.
Exactly. Capital is being invested today in factories that won't achieve meaningful revenue and margin returns for 3 or 4 years. Management's stated goal is to drive that ROIC back into the mid to high teens where it used to be, but that path involves several years of looking like a terrible business first.
And I imagine the same logic applies to free cash flow conversion. We see poor or even negative FCF. The company's a cash furnace right now.
A complete cash furnace. It's consuming capital, not generating it. Even when their net income is positive, the cash generated from operations is entirely swallowed up, and then some, by the gigantic CapEx requirements of IDM 2.0.
So they're depleting reserves, taking on debt.
All to build future capacity. This negative ACF is the financial signature of a high-risk, high-growth venture. All the costs are borne now, and the payoff is highly uncertain and years away.
Let's talk about the balance sheet. Debt levels are rising, which is a departure from Intel's traditionally pristine, cash-rich position. What does this increasing leverage signal to you about the execution risk?
It signals two things. First, it signals their absolute commitment. They are leveraging their strong balance sheet because the scale of the required investments demands it. But second, it signals just how high the stakes are.
The debt is still manageable, right?
For now, yes. The debt is still prudent relative to the company's enormous asset base and massive recurring revenue. But the upward trend in leverage means they have pushed their financial envelope to its limit to make this happen.
Which reinforces the idea that there is no margin for error.
Zero, absolutely zero margin for error on executing the 18A process node, and just as importantly, on securing those big external foundry customers. They simply cannot afford for this debt-funded capital to be wasted.
Given all this financial uncertainty and this extremely high risk, the valuation profile for the stock becomes, well, it feels completely binary.
It is absolutely binary. There's really no middle ground here. When you look at the stock today, on one hand, it's trading at a low valuation based on its depressed near-term earnings and those awful current ROIC figures.
It looks cheap by traditional metrics.
But at the same time, it's trading at a high valuation based on the speculative long-term potential of a successful IDM 2.0 turnaround. This tension is what drives the incredible volatility.
So if it works,
if IDM 2.0 succeeds, if they actually regain process leadership and sign major foundry deals, then today's price is cheap. Possibly ludicrously cheap.
and if it fails,
If they fail to execute, then the hundreds of billions of dollars they've spent is just wasted capital, the business is structurally and permanently impaired, and today's stock price is very, very expensive.
and that gets to a fundamental point about investing in a story like this. The risk in paying even today's price is that you're already paying for some expectation of success.
You are. If the turnaround only achieves, say, parity with TSMC, but never clears superiority, the stock might just languish for years because the market priced in a full-blown success story that didn't quite materialize.
So to compensate for this huge execution risk, an investor needs to find that classic margin of safety. If we can't trust the current earnings, where do we find it?
You have to look beyond the income statement. You find safety in two key areas. The optionality that's being created by all this investment, and the non-replicable assets the company already holds. A low trailing PE ratio is meaningless here.
What do you mean by non-replicable assets?
I mean, the sheer scale of the barrier to entry created by their $20 billion plus annual CapEx budget. No new competitor can just decide to show up tomorrow and replicate that infrastructure. It's impossible. That scale provides a certain kind of safety.
And this ties directly back to the geopolitical angle we mentioned at the start, Intel's status as a strategic national asset.
Correct. This is a huge part of the non-financial margin of safety. Intel is, for all intents and purposes, the last man standing as an at-scale leading-edge foundry in the Western Hemisphere.
Which the U.S. government is very aware of.
Acutely aware. And that status provides a crucial geopolitical floor to the valuation. It unlocks access to billions in government subsidies, like the GPS Act funding. And it provides a kind of national security mandate that ensures the company will receive support during periods of financial stress. Wall Street analysts focused on next quarter's gross margin often overlook this powerful backstop.
Okay, let's get specific. What is the single most important growth driver for this entire bull thesis? Where does an investor need to focus their attention?
It all begins and ends with Intel Foundry Services, IFS. And within that, there are two hurdles they absolutely must clear for the bull case to play out.
Hurdle number one.
They must achieve clear semiconductor process technology leadership, specifically with the 18A node, which is the one using those groundbreaking RibbonFET and PowerVIA technologies, and they have to do it on their stated timeline, which is by 2025 or 2026. This is purely about technical superiority.
And hurdle number two.
Technical superiority is completely useless if nobody buys it.
Yeah.
So second, they must win significant, multi-billion-dollar external foundry contracts from Tier 1 players.
We're not talking about small customers here.
No, we're talking about major mobile phone manufacturers, military clients, big automotive companies, or other large fabulous chip designers. If they can't validate their shiny new technology with real paying customers, the entire IFS pillar of the strategy collapses.
All right, let's flip that coin. Let's detail the permanent impairment risks. What is the one execution failure that could structurally destroy shareholder value forever?
The most existential risk is the failure to deliver 18A on time and with competitive performance and cost. It's that simple.
So if they miss their deadlines?
If they miss the deadlines, or just as bad, if the 18A process turns out to be structurally more expensive to produce chips on than TSMC's equivalent N2 process, then the competitive gap becomes permanent. The hundreds of billions they invested become sunk costs, and Intel is relegated to being a second-tier manufacturer forever.
Which guarantees the stock becomes a value trap.
A classic value trap.
What's the second major risk?
The second is irreversible customer loss in the data center. If the big hyperscalers, Amazon, Google, Microsoft, accelerate their shift to their own in-house ARM-based designs and permanently shrink Intel's highest margin DCA business by, say, another 20 or 30%.
And then the economics of the whole model break down.
They just stop working. They won't have the high margin revenue base from their own products to help fund the never-ending CapEx treadmill of the foundry business.
Conversely, what are the potential catalysts we could see that would dramatically improve the narrative and start to reduce that execution risk in the market's eyes?
The catalysts are all about one word: validation. The single most powerful one would be the announcement of a major Tier 1 foundry customer win.
Something like the rumored Apple contract.
That would be the holy grail. An Apple win or securing a massive Department of Defense contract for advanced chips. A deal like that would instantly validate IFS's technology and significantly de-risk the entire strategy overnight.
And what's the second potential catalyst?
The second is clear: third-party validation. When independent testing firms get their hands on 18A silicon and publish reports showing that it meets, or even better, beats TSMC's performance targets, once that happens, the execution risk narrative that has been this huge weight on the stock for years will finally start to lift.
This is where we need to do some second-level thinking. We need to step back from the surface-level reports. What is the market as a whole fundamentally missing or underweighting about the Intel story right now?
I think the market consensus is deeply entrenched in the show me camp. It sees the ambition of IDM 2.0, but it fundamentally doubts Intel's ability to execute.
Because of their track record over the last decade.
Exactly. They cite a decade of delays, missed targets, and cultural stagnation. So the market focuses heavily on the terrible current ROIC and treats the massive CapEx as just a financial drain, a negative.
But the contrarian view is different.
The contrarian second-level view is that the market is severely underestimating the leverage of the capital choices Gelsinger has made, the dividend cut, the focused use of debt. These investments are creating a deep structural option on future market share and future pricing power that is completely invisible in today's financial metrics.
An option that's essentially unpriced.
It's unpriced. And I think the market is also underestimating the structural geopolitical need for a secure, at-scale Western foundry. This makes it a highly asymmetric bet. The downside of continued struggles is largely baked into the current price, but the potential upside from them just achieving technological parity is enormous and not fully appreciated.
Okay, let's try to summarize the entire investment thesis here. Let's start with the bull case.
The bull case rests on 4 pillars. 1. An indispensable entrenched core business that's still generating massive cash flow to fund the turnaround.
2.
2. Its status as a strategic national asset, which ensures government support and provides a geopolitical backstop.
3.
3. You have management, led by a true engineer, making painful but rational, owner-oriented capital allocation decisions.
And finally, 4.
Nonlinear execution leverage, meaning success on just one process node 18A could unlock decades of margin expansion and market share gains. The payoff is not linear.
That is a very compelling bull case, but now we have to do the most important thing. We have to red team it. What is the central argument of the bear case?
A central argument of the bear case is simple and brutal, that this entire capital allocation strategy is nothing less than a value destruction trap.
A trap.
Yes, and we had to detail what we call the treadmill risk.
For the treadmill risk.
The capital required, that perpetual $20 billion plus per year in CapEx, is so immense, so relentless, that even if they succeed in achieving technical parity with TSMC, it might result in near-zero incremental return on invested capital.
So they spend hundreds of billions just to stay in the same place.
They run as fast as they can just to remain viable, while their asset-light competitors like AMD and NVIDIA capture the highest margins with none of the capital burden.
And if that happens, the stock becomes a perpetual value trap.
A permanent value trap because the massive fab assets on their balance sheet continuously depreciate faster than the new revenue they can generate. It locks the company in a low-return cycle that never, ever justifies the initial investment.
So after this whole deep dive, what does this all mean for you, the listener, as you analyze this company? It seems clear that investing in Intel today is a direct, high-risk, high-reward bet on Pat Gelsinger and his team's ability to navigate what might be the most complex, capital-intensive turnaround in modern technology history.
You're not buying a stable business. You are buying an option on execution.
And that leads us to our final provocative thought for you to take away.
We've spent this whole time meticulously analyzing Intel's execution risk through a financial and a competitive lens. But given the enormous geopolitical push, the PS Act funding, the national security concerns around Taiwan's dominance in chip making, we have to ask a much broader question.
Go on.
If Intel fails to execute 18A on time, what are the non-financial repercussions for the entire Western world? And how large would government intervention have to become to prevent the Western Hemisphere from losing its last major anchor of advanced semiconductor manufacturing capacity?
So the question isn't just about how much money Intel's shareholders might lose.
The question is, what happens if the entire national strategy to reshore critical technology fails right alongside it?
The ultimate question isn't just about Intel's profit, but its purpose and its strategic indispensability. Something to mull over as you watch those 18A process node timelines very, very closely. Thank you for joining us for the deep dive.